Chapter 1: The Volatility Paradigm Shift. For decades, the average investor has been trained to view the market through a narrow, binary lens: up or down, bull or bear, profit or loss. We are conditioned from our very first trade to obsess over direction, fixating on the where of price action while ignoring the how. This directional bias is the gambler's trap. It forces you to be a fortune teller in an unpredictable world, tethering your financial success to the hope that you can guess the next move of a chaotic system. But beneath the surface of these vertical swings lies a far more powerful and reliable engine of opportunity. To gain a true edge, you must stop asking which way the wind is blowing and start measuring the velocity of the gale. Volatility is rarely described as a friend. In the mainstream financial media, it is almost exclusively treated as a synonym for fear or a harbinger of doom. When the VIX spikes, the headlines scream of instability and risk. However, this perspective is fundamentally flawed because it views volatility as a byproduct of market activity rather than a tradable asset class in its own right. The most sophisticated players in the world do not fear movement. They harvest it. For them, volatility is not an obstacle to be avoided, but the very raw material required to manufacture profit. It is the heartbeat of the market, and once you learn to trade the pulse instead of the path, you are no longer at the mercy of the trend. The volatility paradigm shift requires a total rewiring of your psychological approach to the tape. Instead of agonizing over whether a stock will hit a specific price target, the volatility-focused trader asks a different set of questions. Is the market currently underpricing the potential for movement? Is the crowd overestimating the upcoming turbulence? By shifting your focus from direction to intensity, you decouple your P&L from the directional whims of the crowd. You move from the role of a spectator guessing which horse will win the race to the role of the house, which simply profits from the fact that the race is being run at all. This is the foundation of the volatility edge, the realization that price movement itself, regardless of its destination, is the most lucrative commodity on the exchange. Chapter 2: Realized versus Implied: The Professional's Edge. To the uninitiated, volatility is often viewed as a singular, chaotic force, a measure of how fast a stock might crash or how high it might fly. But to the professional, volatility lives a double life. On one side of the ledger, we have realized volatility, the hard, unyielding data of the past. It is the footprint left in the snow, a mathematical record of how much an asset actually fluctuated over a specific period. It is objective, cold, and retrospective. It tells us exactly where the market has been, but like a rearview mirror, it offers no promises about the curve in the road ahead. On the other side of the ledger lies implied volatility, IV, the domain of the strategist and the gambler alike. IV is not a record of facts, but a collection of opinions. It is the marketplace's collective forecast of future turbulence, baked directly into the prices of options. When uncertainty looms, be it an upcoming earnings report, a messy election, or a whisper of a central bank rate hike, IV swells. It represents the insurance premium that investors are willing to pay for protection. Unlike its realized cousin, implied volatility is forward-looking and inherently emotional. It is the physical manifestation of the market's fear and greed, priced in real time. The professional's edge is found in the gap between these two numbers. Historically, the market is a chronic overestimator of its own demise. Implied volatility typically commands a higher price than what realized volatility eventually delivers, a phenomenon known as the volatility risk premium, VRP. This structural imbalance is the cornerstone of professional trading. While the amateur reacts to the headlines, the professional seeks to sell the fear, high IV, and wait for the reality, lower realized volatility, to settle the bill. Understanding this distinction is the moment you stop betting on direction and start trading the spread between expectation and reality. Chapter 3: Inside the VIX: Decoding the Market's Fear Gauge. To the uninitiated, the CBOE Volatility Index, or the VIX, is often whispered about as if it were a dark omen, a digital barometer of impending doom. Popularly known as the fear gauge, it is the market's primary neurological sensor, flickering higher the moment investors begin to lose their nerve. Yet, to see it only as a measure of panic is to miss its true structural genius. The The VIX doesn't track where the market has been, nor where it is currently standing. Instead, it looks 30 days into the future, distilling the collective anxieties and expectations of the world's most sophisticated traders into a single, vibrating number. At its core, the VIX is a mathematical derivative of the S&P 500 index options. When institutional fund managers grow nervous about a potential downturn, they rush to buy insurance in the form of put options. This surge in demand drives up the price, or the implied volatility, of those options. The VIX calculation strips away the noise and aggregates these prices to reveal a real-time consensus on how much turbulence the market expects to endure. It is the sound of the crowd bracing for impact, translated into a decimal point. This mechanics-driven process explains the famous inverse relationship. When the S&P 500 slides, the VIX typically screams higher. This isn't just a coincidence of sentiment. It is rooted in the fundamental human asymmetry toward risk. We feel the pain of a loss far more acutely than the joy of a gain, and we are willing to pay a premium to protect what we have when the horizon darkens. While the equity markets represent the engine of wealth, the VIX represents the cost of the airbag. Understanding this psychological tether is the first step in turning volatility from a threat into a tool. Market fear is rarely rational in its intensity, often overshooting the actual fundamental risk. By decoding the VIX, you aren't just watching a gauge of panic, you are gaining a vantage point over the crowd's reflexive behavior. You begin to see that while the average investor views a spiking VIX as a signal to flee, the volatility trader views it as a period where the insurance is being mispriced, creating the precise openings needed to profit when the smoke eventually clears. Chapter 4: The Power of Vega. Measuring Volatility Sensitivity. The average investor is well versed in the language of direction, the frantic dash to buy when green arrows point upward, and the gut-wrenching dread when red candles dominate the screen. They live and die by delta, even if they don't use the term, obsessed with whether a stock moves a dollar higher or a dollar lower. But for the volatility trader, price movement is merely the surface tension of a much deeper ocean. Beneath the waves lies a different force entirely, a silent, creeping pressure that can inflate the value of a portfolio or hollow it out from the inside, even if the underlying stock price doesn't move an inch. This is the realm of Vega. Vega is the Greek that measures your sensitivity to implied volatility. Specifically, it represents the amount an option's price is expected to change based on a single percentage point move in implied volatility. While delta tracks the path of the asset, Vega tracks the fear and greed index baked into the option's premium. Understanding Vega is the difference between being a gambler who hopes for a lucky break and a technician who understands the structural engineering of a trade. When you master Vega, you stop asking where the market is going and start asking how much the market is willing to pay for the future's uncertainty. Visualizing your portfolio through the lens of Vega requires a fundamental shift in perspective. You are no longer just holding a collection of stocks or options. You're managing a volatility bucket. Every long call or put you own adds Vega to your bucket, making you a beneficiary of rising fear. Every short position you sell drains that bucket, leaving you short Vega and vulnerable to a spike in market turbulence. To profit in any condition, you must learn to aggregate these exposures. You need to know with mathematical certainty how a 1% jump in the VIX will impact your bottom line. Calculating this exposure at the portfolio level is where the amateur is separated from the professional. It is not enough to know the Vega of a single trade. You must understand your net portfolio Vega. This is the sum of your volatility sensitivities across all positions, adjusted for their correlation to one another. By mastering this metric, you gain the ability to dial in your exposure. You can design a portfolio that remains indifferent to price swings but harvests massive gains when the market suddenly wakes up to a forgotten risk. In this chapter, we will move past the theoretical and into the mechanical, learning exactly how to measure, manage, and monetize the hidden power of Vega. Chapter 5: Volatility. Term structure: reading the yield curve of fear. To the uninitiated, the VIX is often viewed as a solitary number, a fear gauge that flickers on a screen like a digital pulse. Yet, professional traders know that volatility is not a static point. it is a landscape. To truly understand where the market is going, you must look beyond the spot price and peer into the volatility term structure. This is the yield curve of fear, a graphical representation of what the market expects volatility to be today, next month, and 6 months into the future. By mapping these expectations through VIX futures, we can discern the underlying health of the financial system and identify the invisible shifts in sentiment that precede major price movements. In a healthy trending market, the term structure typically exists in a state of contango. This upward sloping curve reflects a logical reality. The distant future is inherently more uncertain than the immediate present, and investors are willing to pay a premium for long-term insurance. This steady slope is the heartbeat of a complacent bull market, acting as a tailwind for those who harvest volatility risk premia. When the curve is in contango, the market is signaling that while it expects occasional ripples, it believes the long-term structural integrity of the trend remains intact. For the volatility trader, this is the time of the grind, where profits are made through the steady decay of overvalued protection. However, the most lucrative and dangerous opportunities arise when this relationship flips. When the curve enters backwardation, the slope inverts, and the price of immediate protection surges above the cost of future insurance. This inversion is a siren blaring on the deck of a ship. It signals a volatility spike triggered by a sudden, systemic shock where market participants are so desperate for liquidity and protection now that they cease to care about the horizon. This is the yield curve of fear in its most panicked state. Understanding the transition between these two states is the essence of the volatility edge. By monitoring the roll yield and the steepness of the curve, we can tell if a market dip is a mere buying opportunity or the beginning of a structural regime shift. The term structure doesn't just tell you that people are afraid, it tells you exactly how long they expect that fear to last. Whether you are a hedger looking to protect a portfolio or a speculator seeking to profit from the chaos, the VIX futures curve is your most reliable map for navigating the stormy waters of market sentiment. Chapter 6: Mean Reversion, the mathematical certainty of volatility. In the chaotic arena of the financial markets, there are few laws as ironclad as gravity. While stock prices can climb toward the stratosphere for decades or sink into the abyss of bankruptcy, volatility operates on a different set of physics. It is tethered to a center. When volatility spikes, it is not an escalator ride to infinity. It is the stretching of a high-tension rubber band. The further it is pulled away from its historical average, the greater the kinetic energy pulling it back toward the center. This is mean reversion, the mathematical backbone of the volatility edge, and the reason why volatility is one of the few assets in the world that can be reliably timed. To understand this concept, one must stop viewing volatility as a trend and start viewing it as a heartbeat. If you look at a long-term chart of the S&P 500, you see a jagged but persistent climb toward the upper right corner. But if you look at a chart of the VIX, you see a different story, a series of frantic, irregular pulses that always return to a foundational baseline. High volatility is fundamentally unsustainable because it reflects a state of panic, and panic, by its very nature, is an exhausting emotion. Eventually, the market grows weary of the drama, the selling pressure dissipates, and the implied fear begins to bleed out of option premiums, dragging the numbers back to the mean. The strategic advantage here lies in the rubber band effect. Most traders lose money because they chase momentum, buying into the peak of the spike just as the tension is at its maximum. The volatility expert, however, looks for these moments of extreme extension. When the VIX is stretched 3 standard deviations away from its mean, it is no longer a question of if it will fall, but when. By understanding the mathematical certainty that calm will eventually follow the storm, you transition from a gambler guessing at direction to a physicist calculating the inevitable snapback. You don't need to predict the future, you only need to recognize when the present has become a statistical outlier. Chapter 7: VOR, Rank and Percentile. Identifying relative volatility value. To the uninitiated, a casual glance at a stock's implied volatility, IV, provides a number that feels strangely abstract. Seeing an IV of 40% tells you that the market expects a certain degree of movement, but it fails to answer the most critical question in a trader's arsenal. Is this volatility actually expensive? Without historical context, a single IV reading is like looking at a thermometer in a foreign city without knowing the local climate. A temperature of 60 degrees might be a heat wave in the Arctic or a cold snap in the tropics. To gain your edge, you must stop looking at volatility in a vacuum and start measuring it against its own history. This is where IV rank and IV percentile become the dual pillars of your trading strategy. These metrics move us away from the what and toward the where, allowing us to plot the current volatility on a map of the past year's extremes. A 4 rank tells you where the current IV sits in relation to the absolute high and low of the last 52 weeks, effectively normalizing the data on a scale of 0 to 100. If a stock's IV has swung between 20% and 60% over the year, and it currently sits at 40%, its IV rank is 50. This immediate visualization transforms a raw percentage into a binary signal. Are we in a period of relative calm, or are we standing in the eye of a storm? While IV rank provides a linear look at the range, IV percentile offers a more nuanced view of frequency, telling you what percentage of the time volatility has traded below current levels. This distinction is vital for the volatility trader. You might find a stock with a high IV rank that actually spends very little time at those elevated levels, suggesting an imminent mean reversion, the tendency for volatility to snap back to its average. By mastering these two tools, you move beyond guesswork and begin to identify true value. You stop being a gambler, reacting to price swings, and start acting like an insurance underwriter, selling protection when the premiums are historically overinflated and buying it only when it is clearance priced. Chapter 8, The Iron Condor, the flagship non-directional strategy. To the uninitiated, the stock market is often viewed as a binary battlefield. You are either a bull charging toward higher prices or a bear betting on a collapse. But for the volatility trader, the most lucrative state of affairs isn't a dramatic surge or a gut-wrenching plunge. It is the sound of nothing happening at all. The Iron Condor is the crown jewel of this market-neutral philosophy. It is a strategy designed to harvest profit from the passage of time and the evaporation of fear, allowing you to act as the house in a casino where the odds are mathematically tilted in your favor. When you crawl into an Iron Condor, you aren't guessing which way the wind will blow. You are betting that the wind won't turn into a hurricane. Structuring the trade requires a symmetrical precision that appeals to the architectural mind. By simultaneously selling an out-of-the-money bear call spread and an out-of-the-money bull put spread, you create a wide profit zone or valley between your two short strikes. As long as the underlying asset meanders within this range until expiration, the options you sold will lose value, and you get to keep the initial credit as pure profit. This is the essence of being short volatility. You are essentially selling insurance to both the panicked bulls and the fearful bears, collected premiums from both sides, while the market remains comfortably stagnant. The true magic of the Iron Condor, however, lies in the dual engine of theta decay and volatility crush. Every day, the market remains within your boundaries. Time decay, theta, relentlessly eats away at the value of the options you've sold, depositing that lost value into your account. Furthermore, because these trades are typically entered when implied volatility is high, you stand to gain significantly when the market calms down. As IV contracts, the price of the entire spread shrinks, allowing you to buy the position back for pennies on the dollar long before the expiration date. It is a sophisticated way to monetize the realization that the market's fears were, in fact, overblown. But do not mistake this for a set-it-and-forget-it gamble. While the Iron Condor offers a high probability of success, it demands a disciplined approach to risk management. In the following pages, we will deconstruct the mechanics of the trade, from selecting the optimal deltas and expiration cycles to the art of defensive adjustments. You will learn how to widen your wings when the market gets turbulent, and how to exit with grace when your profit targets are met. Mastery of the Iron Condor is more than just learning a formula. It is about developing the temperament to profit from the mundane. Chapter 9. Selling straddles and strangles, harvesting pure premium. To the uninitiated, the short straddle is the ultimate expression of market hubris. By simultaneously selling an at-the-money call and an at-the-money put, you are essentially planting a flag in the sand and betting that the giants of the exchange will stand perfectly still. It is a strategy designed for the eye of the storm, a deliberate harvest of pure premium that seeks to exploit the rich, overinflated expectations of volatility that often precede a period of calm. While long volatility strategies thrive on chaos, the short straddle thrives on the silence that follows, turning the relentless decay of time into a steady, daily realized profit. The strangle offers a slightly more forgiving variation, trading some of that raw premium for a wider margin of error. By selling out-of-the-money options above and below the current price, you create an expectancy zone, a wide valley where the stock can wander without threatening your capital. This is not gambling on where the market will go, but rather on where it will not go. It is a high-probability game played by those who understand that markets spend significantly more time migrating sideways than they do in a state of vertical panic. In these neutral structures, your primary enemy isn't necessarily a price move, but rather the stubborn refusal of implied volatility to revert to its mean. However, harvesting premium is a game of pennies and steamrollers if one ignores the mechanics of undefined risk. Unlike a spread, where your losses are capped by a protective long wing, a naked strangle or straddle leaves you exposed to the raw fury of an outlier event. This chapter is not merely about the mechanics of the sale, but about the discipline of the defense. Mastery of the volatility edge requires knowing exactly when to stay small, how to adjust the tested side when the market breaches your perimeter, and most importantly, identifying the specific market conditions where the reward for taking on unlimited risk is mathematically weighted in your favor. Chapter 10: Buying the Breakout: Long Volatility Strategies. The market often finds itself in a state of coiled tension, a period of quiet consolidation that belies the explosive energy building beneath the surface. For the traditional directional trader, these periods are a frustrating waiting game, a coin flip on whether the eventual break will go up or down. But for the volatility trader, the direction is secondary to the magnitude. When you enter a long straddle or a long strangle, you are no longer betting on a path. You are betting on a realization of movement. You are buying the right to profit from chaos, positioning yourself to capture the wind regardless of which way the gale blows. Consider the atmosphere leading up to a high-stakes earnings announcement or a pivotal Federal Reserve rate decision. The air is thick with uncertainty, and the implied volatility IV begins to swell as investors pay a premium to protect their positions. This is the volatility edge in its purest form. By purchasing both a call and a put, you are essentially purchasing a ticket to a theater of movement. If the stock gaps 10% in either direction, one side of your trade decays towards zero, while the other side appreciates at an accelerating non-linear rate. The goal is not to be right about the company's future, but to be right about the market's collective surprise. The long straddle, buying an at-the-money call and put with the same strike price and expiration, is the most aggressive way to play this expected turbulence. It requires the greatest move to reach profitability, but it offers the most immediate delta sensitivity the moment the break occurs. For those looking for a slightly lower entry cost, the long strangle involves buying out-of-the-money options, widening the valley the price must cross, but lowering the initial capital at risk. Choosing between them is a matter of balancing your conviction in the move against the harsh reality of time decay, or theta. Success in these strategies hinges on the timing of your entry. If you buy the breakout after it has already begun, you are likely paying an ignorance tax in the form of inflated premiums. The true professional buys the breakout when the market is still sleeping, identifying those rare moments when the cost of the options is significantly lower than the historical reality of the impending move. You are looking for those specific windows where the market has underpriced the potential for a shock, allowing you to buy volatility on the cheap before the world wakes up to the new reality. Chapter 11: The Calendar Spread: Trading Volatility Across Time. In the arena of modern finance, time is rarely a neutral observer. It is either your most relentless adversary or your most reliable benefactor. The calendar spread, often called a horizontal spread, is the sophisticated trader's method of bending the dimension of time to their advantage. Unlike vertical spreads that gamble on the direction of price, or straddles that bet on the magnitude of movement, the calendar spread finds its edge in the discrepancy between the now and the later. By selling a short-term option and simultaneously purchasing a longer-dated one at the same strike price, you are essentially positioning yourself at the intersection of two different speeds of decay. The fundamental logic of this strategy rests on the nonlinear nature of theta, or time decay. Options do not lose value at a steady pace, rather they experience an accelerative collapse as they approach expiration. By selling front-month volatility, you are capturing that rapid terminal erosion, while your long-dated position acts as a stabilizing anchor, retaining its value far more efficiently. In a high-volatility environment, this creates a unique psychological and financial buffer. You are not just trading a ticker symbol. You are trading the market's changing expectations of risk across a temporal horizon. The true magic of the calendar spread, however, reveals itself when we look at the term structure of volatility. Not all volatility is created equal, and it rarely moves in a uniform fashion across all expiration cycles. There are moments, often preceding major earnings announcements or macroeconomic shifts, where short-term implied volatility becomes artificially inflated relative to the long term. This volatility skew creates a window of opportunity where the trader can sell overpriced fear in the near term while owning a relatively cheap insurance policy for the future. It is a strategy of surgical precision, allowing you to profit from a stagnant market while remaining braced for the long-term shifts that define the volatility edge. Chapter 12: VIX ETPs, Trading Volatility Without an Options Account. For the average retail investor, the CBOE Volatility Index, VIX, often feels like a forbidden fruit, a powerful signal of market distress that remains tantalizingly out of reach because they lack the specialized clearance for a complex options or futures account. Yet the financial engineering boom of the last decade has democratized access to the fear gauge through exchange-traded products, ETPs. Instruments like VXX and UVXY have bridged the gap, allowing anyone with a standard brokerage account to bet on market turbulence as easily as they would buy shares of a blue-chip tech stock. These vehicles offer a seductive proposition: the ability to profit directly from rising anxiety without ever having to navigate an options chain. However, beneath the simple ticker symbols lies a mechanical beast that many investors fail to respect. Unlike a traditional stock that represents equity in a company, VIX ETPs are derivative-based instruments that track a rolling portfolio of short-term VIX futures. Because the VIX itself is a mean-reverting calculation and not an investable asset, these ETPs are governed by the laws of roll yield. In normal market conditions where future turbulence is priced higher than current levels, a state known as contango, the fund must constantly sell cheaper futures to buy more expensive ones. This creates a relentless, silent erosion of value, a decay that can bleed a long-term position dry even if the broader market remains relatively flat. Treating these products like buy-and-hold investments is perhaps the most common and costly mistake in the volatility space. They are not shields to be stored in a cellar for a rainy day. They are tactical grenades designed for high-impact, short-duration maneuvers. When the market cracks, products like UVXY can explode upward with breathtaking speed, providing a powerful hedge or a speculative windfall in a matter of hours. But the moment the panic subsides, the clock begins ticking again. To master the volatility edge, one must view these ETPs not as assets to be owned, but as precision tools to be rented, utilizing their explosive upside while remaining acutely aware of the structural gravity that constantly pulls their price towards zero. Chapter 13: Vertical Skew, Understanding the Market's Insurance Pricing. The financial markets are rarely a level playing field, and nowhere is this imbalance more visible than in the pricing of equity options. If the market were a perfectly symmetrical machine, a 10% move to the upside would cost exactly the same to insure as a 10% move to the bottom. But the market isn't a machine. It is a manifestation of human psychology, and humans are hardwired to fear the abyss more than they crave the peak. This fundamental asymmetry is what we call vertical skew. It is the visual representation of the market's collective anxiety, appearing on your screen as a persistent tilt, where out-of-the-money puts command a significant premium over equidistant out-of-the-money calls. Think of vertical skew as the market's insurance ledger. When you buy a homeowner's policy, you pay a premium not because you expect your house to burn down, but because the cost of that catastrophe is too great to bear alone. In the options landscape, institutional fund managers operate under a perpetual state of crashophobia. They are constantly forced to buy downside protection to hedge their massive long portfolios, driving the price of protective puts higher. This structural demand creates a steep curve in implied volatility, effectively telling us that the market charges more for disaster insurance than it does for lottery tickets. Learning to read this skew is like gaining access to a master thermometer for global risk. When the skew flattens, it suggests a dangerous level of complacency, a market that has forgotten what a correction feels like. Conversely, when the skew steepens aggressively, it signals that the big money is scurrying for cover, paying exorbitant prices to protect against a looming tail risk event. By understanding the mechanics of why these price discrepancies exist, you stop being a victim of expensive insurance and start becoming the one who understands how to price theater tickets in a room where everyone is suddenly smelling smoke. Ultimately, vertical skew is the map that shows us where the hidden leverage lies. While a novice trader might look only at a stock's price, the volatility professional looks at the shape of the curve to see where the market is placing its heaviest bets. In this chapter, we will strip away the complex calculus and look at skew through the lens of supply and demand. You will learn how to identify when the insurance is overpriced, when the crash protection is a bargain, and how to use this tilt to tilt the odds of profitability in your favor. Chapter 14, The Earnings Play, Trading the Implied Volatility Crush. The quarterly earnings season is a financial spectacle that functions much like a high-stakes poker game, where everyone must show their cards at the same time. In the weeks leading up to the announcement, the market is consumed by a mounting sense of mystery. Analysts adjust their models, whisper numbers circulate through trading desks, and speculative fervor drives the demand for options to a fever pitch. This collective anxiety manifests as a steady climb in implied volatility, IV, the market's way of pricing in the unknown. As the clock ticks closer to the release, the cost of protection skyrockets, creating a volatility bubble inflated by the sheer weight of uncertainty. Then comes the moment of impact. Whether the company beats expectations or misses them, the mystery is solved, and the unknown suddenly becomes known. This is the catalyst for the implied volatility crush, a violent, rapid collapse in option premiums that can occur in seconds. For the uninformed retail trader, it is a source of immense frustration to see a stock move in their predicted direction, only to watch their call or put options lose value anyway. They have fallen victim to the crush. But for the volatility trader, this predictable cycle represents one of the most reliable opportunities in the market, the systematic harvesting of overinflated insurance premiums. To master the earnings play, one must stop betting on the direction of the stock and start trading the disappearance of fear. By analyzing the historical volatility cycles of specific equities, we can identify volatility outliers, instances where the market is overestimating the potential move. The goal is to position oneself on the sell side of the uncertainty, structured in a way that allows us to capture the premium collapse while mitigating the risk of a gap move. Trading the IV crush is not about guessing the news. It is about recognizing that the market's anticipation of the news is almost always more expensive than the reality itself. Chapter 15, Managing Black Swan Risk, When Volatility Explodes. The market possesses a deceptive memory. It lulls you into believing that the distribution of outcomes follows a neat, predictable bell curve. But volatility is not a static number. It is a coiled spring. Most traders spend their careers managing directional risk, obsessing over whether the index will climb or crawl. Yet, the true predator in the ecosystem isn't a change in price, but the sudden, violent expansion of volatility itself. When a black swan takes flight, it doesn't just move the needle, it shatters the gauge. This represents the moment where normalized volatility evaporates, replaced by a chaotic surge that renders standard stop losses and historical correlations utterly meaningless. In these high-velocity environments, the silent killer is gamma risk. While delta measures your exposure to the price, gamma measures how quickly that exposure accelerates. When volatility explodes, your Greeks are no longer stable coordinates. They become runaway engines. A position that felt hedged and comfortable at the market close can become a catastrophic liability by the following morning's opening bell, because gamma has forced your delta exposure to balloon beyond your capital's breaking point. You aren't just losing money on the move, you are losing money on the increasing speed of the move. Surviving these episodes requires a fundamental shift in perspective. You must stop managing for the probable and start insulating against the possible. To master the volatility edge, you must build a fortress that assumes the impossible happens once a decade. This involves more than just buying protective puts. It requires a structural understanding of liquidity gaps and the convex nature of tail risk hedging. True risk management during a black swan event is not about predicting the crash, but about ensuring that when the market moves faster than the human mind or the trading algorithm can process, your portfolio's architecture remains intact. We do not seek to avoid the storm, for the storm is where the greatest profits are forged. Instead, we ensure our vessel is built to thrive when the waves exceed the height of the masts. Chapter 16: Capital Allocation and Margin for the Volatility Specialist. For the volatility specialist, capital is more than just a balance sheet. It is raw fuel. However, unlike a traditional buy-and-hold investor who views capital through the lens of price appreciation, the volatility seller must view it through the lens of efficiency and structural risk. The central challenge of this discipline is not simply finding an edge, but sizing that edge so it survives the inevitable spikes in market turbulence. To master the volatility edge, you must move beyond the amateur's focus on nominal trade value and master the mechanics of buying power reduction, BPR. Every contract you sell consumes a portion of your operational capacity. Knowing exactly how much that capacity shrinks during a vol expansion is the difference between a career-defining year and a catastrophic margin call. Effective capital allocation in a volatility-centric portfolio requires a psychological shift from how much can I make to what is my stress-tested capacity. Margin requirements are not static figures. They are dynamic, breathing entities that expand when the market becomes unhinged. When you sell a naked put or a straddle, you are essentially renting space in your account. During periods of low realized volatility, that rent is cheap and margin requirements are lean. But when the VIX doubles, the clearinghouse demands a premium for that same space. If you have scaled your positions to the ceiling during the quiet times, you leave yourself no runway for the very environment where your strategy should theoretically thrive. The goal of the volatility specialist is to achieve a state of aggressive conservation. This means deploying enough capital to generate meaningful alpha while maintaining a buffer that allows you to stay liquid when the rest of the market is being liquidated. We solve this by calculating our margin-to-equity ratio under various stress scenarios, ensuring that even a 3 standard deviation move doesn't trigger a forced exit. By treating margin as a finite precious resource rather than an infinite line of credit, you transform from a gambler hoping for calm seas into a professional operator who can navigate and profit from the most violent storms. Chapter 17: The Art of the Adjustment: Fixing Volatility Trades Gone Wrong. In the world of high-stakes trading, the opening bell is often treated with the reverence of an orchestral overture. Yet the true mastery of the craft is found not in the initial baton strike, but in the frantic, mid-performance tuning that happens when the melody begins to sour. If market entry is the offense, the bold play driven by conviction and data, then trade management is the gritty, indispensable defense that actually wins championships. Most retail traders treat a losing volatility position like a wildfire they are powerless to stop, watching in frozen silence as their capital turns to ash. Professionals, however, view a trade gone wrong as a puzzle that hasn't been solved yet. They understand that the entry is merely a set of opening assumptions, and when the market proves those assumptions false, the real work begins. Success in volatility trading is rarely a straight line from point A to point B. It is an exercise in constant calibration. When a short straddle begins to bleed, or a credit spread is breached by a sudden spike in the VIX, your primary objective shifts from profit maximization to damage control and capital preservation. This is where the art of the adjustment takes center stage. You are no longer trading the market, you are trading your own Greeks. By rolling strikes to collect more premium or extending duration to give the position time to breathe, you are effectively buying the most valuable commodity in the world, the opportunity to stay in the game. An adjustment isn't an admission of defeat. It is a tactical pivot that transforms a guaranteed loss into a manageable risk. The psychological hurdle of fixing a broken trade is often higher than the technical one. It requires the humility to admit the market has moved against you and the discipline to act before a manageable crack becomes a structural failure. To master the volatility edge, you must embrace the philosophy that no trade is set it and forget it. Whether you are narrowing your wings to neutralize deltas or rolling a challenged position into a new expiration cycle, you are exercising control over the one thing you can truly influence: your exposure. This chapter will strip away the panic of the losing trade and replace it with a clinical, systematic framework for defensive maneuvering, ensuring that when the market throws a punch, you have the footwork to stay standing. Chapter 18: Hedging with Volatility, Protecting the Core Portfolio. For most investors, market volatility is a ghost in the machine, an unpredictable force that threatens to dissolve years of hard-earned gains in a matter of weeks. We are conditioned to view a rising VIX as a harbinger of doom, a signal to batten down the hatches and weather the storm. But what if you stopped viewing volatility as a threat and started treating it as a premium? Just as a homeowner pays a monthly fee to insure against a catastrophic fire, the sophisticated investor allocates a specific volatility budget to protect their core holdings. This isn't a bet on failure. It is the structural scaffolding that allows your portfolio to remain standing when the broader index begins to buckle. The most direct instrument for this architecture is the VIX call option. Because volatility tends to spike violently and disproportionately when the S&P 500 drops, a small, out-of-the-money position in VIX calls can act as a high-powered slingshot. While your blue-chip stocks may be sliding down the mountain, these volatility hedges are designed to explode upward, offsetting your equity losses with rapid-fire capital gains. The goal is not to get rich off the hedge itself, but to create a flat performance curve during a 20% market correction, giving you the psychological and financial fortitude to hold your long-term positions while others are panic selling at the bottom. If VIX calls are the explosive reaction to a crisis, put spreads on the underlying index are the precision surgical tools. By purchasing a put spread, you are essentially defining a protected zone for your portfolio, limiting your downside within a specific range while keeping the cost of the insurance manageable. This strategic spending, allocating perhaps 1 to 2% of your total capital toward these protective structures, transforms volatility from a source of anxiety into a calculated expense. It ensures that when the once-in-a-decade correction inevitably arrives, you aren't just surviving the chaos, you are positioned to profit from the very volatility that is paralyzing the rest of the market. Chapter 19: The Volatility Smile, Practical Applications of Local Volatility. In the clean, clinical world of the Black Scholes model, volatility is treated as a constant, a single, unwavering number that applies equally to every strike price and every expiration. But walk onto any trading floor or open a live options chain, and you'll see a different reality. You'll see the volatility smile, that telltale U-shaped curve that reveals how the market prices the fear of extreme outcomes. This curve isn't just a mathematical quirk. It is a living map of market sentiment, proving that volatility is a function of where the price is today and where the crowd fears it might go tomorrow. To trade the edge, you must understand that volatility is not a static property of an asset, but a shifting landscape that warps as the price moves. The true challenge for the practitioner begins the moment the underlying asset price starts to drift. As the market moves, how does the smile move with it? This is where we encounter the pivotal distinction between sticky strike and sticky delta regimes. In a sticky strike environment, the implied volatility for a specific price level remains anchored, regardless of where the stock is currently trading. This suggests a market driven by structural supply and demand at specific price points. Conversely, in a sticky delta regime, the smile shifts laterally with the spot price, maintaining the same skew relative to the at-the-money position. Knowing which regime you are in isn't just academic. It dictates whether your hedges will hold firm or disintegrate when the market gains velocity. Practical application of local volatility requires moving beyond the surface-level observation of the smile and peering into the volatility surface. If the smile represents a snapshot in time, local volatility represents the instantaneous volatility at every possible price and time coordinate. It is the engine under the hood. By utilizing local volatility models, we can account for the fact that the market's expectation of future turbulence evolves as the asset moves through different price neighborhoods. When you stop viewing volatility as a flat percentage and start seeing it as a dynamic field of force, you stop gambling on price direction and start profiting from the very geometry of the market. Chapter 20: Contrarian Volatility, Using Fear to Time Market Entries. The crowd is never more unified than when it is paralyzed by fear. In the depths of a market rout, the air thickens with a singular, suffocating narrative that the decline is permanent and the bottom is a trap. It is during these moments of peak emotional exhaustion that the VIX, the market's fear gauge, stops acting as a mere indicator and starts functioning as a lighthouse. While the untrained eye sees a vertical spike in volatility as a reason to flee, the contrarian sees it as the ultimate exhaustion signal. When the VIX screams, it is often the sound of the last panicked seller finally throwing in the towel. Identifying a true market bottom requires an understanding of volatility divergence, the subtle art of noticing when price and fear are no longer moving in lockstep. During the initial stages of a crash, the VIX and the market move in a perfect inverse correlation. As stocks plummet, volatility surges. However, as a bottom begins to form, a curious phenomenon often occurs. The market may hit a new low on the price chart, but the VIX fails to reach a new high. This volatility divergence suggests that the intense emotional velocity of the crash is dissipating. The sellers are exhausted, the smart money is beginning to accumulate, and the sheer force of the panic has lost its momentum. To profit from this edge, one must learn to view a VIX spike not as a catastrophe, but as a compressed spring. History has shown that extreme spikes above the 30 or 40 level are rarely sustainable. They represent a state of market fever that must eventually break. By using these spikes as a contrarian entry signal, you are essentially betting on the return of sanity. You aren't just buying equities. You are buying the inevitable mean reversion of human emotion. Entering a long position when the VIX is at its apex allows you to capture the rapid volatility crush that occurs when the market stabilizes, providing a powerful tailwind to your returns, as the rest of the world is still waiting for the all-clear signal that will never come. Chapter 21: Backtesting Volatility, Validating Your Edge with Data. The allure of a volatility strategy often lies in its mathematical elegance. But the markets are a graveyard for beautiful theories that failed to account for the jagged reality of historical price action. To move from a conceptual edge to a tradable system, you must subject your strategy to the fire of backtesting. This is not merely a process of curve fitting or seeking a high Sharpe ratio. It is an interrogation of your strategy's survival instincts. You are looking to see how your logic holds up when the VIX doubles in a single session, or when the realized volatility of an underlying asset detaches violently from its implied premium. A robust backtest requires more than just a spreadsheet and a string of closing prices. It demands 1% or even tick-level data that captures the intraday fluctuations where volatility traders live and die. When constructing your test, you must focus on the volatility regime, the specific market environment defined by its level of turbulence. A strategy that prints money during the slow, grinding melt-up of 2017 might be decimated in the flash crash mechanics of 2010 or the liquidity vacuum of March 2020. Validating your edge means proving that your rules can navigate these distinct climates without blowing up your account. To truly stress test your thesis, you must intentionally seek out the outliers. You cannot claim to have a master grip on volatility if your backtest ignores the great financial crisis of 2008 or the relentless inflationary bear market of 2022. These periods are not anomalies to be smoothed over. They are the essential proving grounds. As you analyze the data, pay closer attention to your maximum drawdown and the tail risk than to your total returns. In the world of volatility trading, the goal of a backtest is to ensure that you stay in the game long enough for your statistical edge to actually manifest. Chapter 22, The Algorithmic Impact: How High-Frequency Trading Affects Vol. The modern marketplace is no longer a shouting match of colorful vests on a physical floor. It is a silent, cold-blooded symphony of silicon and light. At the center of this digital ecosystem are the high-frequency trading, HFT, firms and algorithmic market makers who provide the bedrock of liquidity. These entities do not trade based on conviction or long-term value. They trade on the math of the spread. By managing gargantuan books of delta and vega in real time, these algorithms act as the lung of the market, breathing liquidity in and out within milliseconds. However, for the uninitiated retail trader, this mechanical efficiency can feel less like a service and more like a predatory trap designed to exploit the slightest delay in execution. To understand the algorithmic impact on volatility, one must first grasp the concept of toxic order flow. Market makers thrive on balanced, uninformed trade, the retail investors buying or selling for personal strategic reasons. They struggle, however, when they are picked off by informed flow, usually from institutional whales or faster algorithms that know a price move is imminent before the market maker can adjust their quotes. To protect themselves, these algorithms are programmed to sniff out predictable patterns and exploit lag in the retail space. If you are entering orders with wide spreads or using basic market instructions during periods of high turbulence, you aren't just trading. You are essentially signaling the machines to front-run your liquidity needs at your own expense. Surviving in this high-velocity environment requires a shift in the retail mindset from directional gambler to stealth operator. The goal isn't to beat the machines at their own game. You cannot compete with a fiber optic cable, but rather to avoid becoming their fuel. This means utilizing limit orders with surgical precision, understanding the gamma hedging windows where algorithms are forced to buy or sell regardless of price, and recognizing that sudden spikes in volatility are often the result of automated feedback loops rather than fundamental news. By learning to decode the digital fingerprints left by these high-frequency players, you can position yourself where the machines provide the exit ramp for your profit, rather than the wall that stops your progress. Chapter 23. The Psychology of Uncertainty: Maintaining the Seller's Discipline. To the uninitiated, selling volatility feels like walking into a storm while everyone else is running for cover. When market turbulence spikes and the financial news cycle shifts into a frantic, high-pitched hum, the natural human impulse is to seek protection, to buy the metaphorical insurance policy at any cost. As an options seller, your role is to be the one underwriting that policy. You are the casino amidst a frenzy of gamblers, the steady hand providing liquidity when the crowd is gripped by the primal urge to flee. This reversal of roles requires more than just a functional understanding of Greek variables. It demands a fundamental retooling of your psychological architecture. The pressure of the contrarian's burden is most acute when the red screens of a market sell-off begin to flicker. In these moments, the herd is buying lottery tickets, driven by the seductive hope of a massive payout or the desperate need to hedge against catastrophe. As a seller, you are standing on the other side of that trade, collecting premiums that feel like pennies in front of a steamroller. The discipline required to stay the course is not about ignoring the risk, but about contextualizing it. You must internalize the reality that high implied volatility is not a warning to stay away. It is the very harvest you have been waiting for. The edge in your strategy is birthed from the irrationality of others' fear. But that edge only yields profit if you possess the mental fortitude to remain the house when the players at the table start winning a few hands. Maintaining the seller's discipline means mastering the art of the clinical perspective. When the VIX screams higher, your amygdala will scream with it, urging you to close positions and retreat to the safety of cash. However, successful volatility trading is built on the statistical truth that fear is almost always overpriced. To profit, you must detach your ego from the daily fluctuations of your P&L and focus instead on the integrity of your process. You are not a speculator guessing the direction of a stock. You are a risk manager harvesting the fear premium that markets naturally generate. True discipline is forged in the silence between the chaos of the trade and the finality of the settlement. It involves the rigorous adherence to position sizing and risk limits that you established when the markets were calm, ensuring that no single spike in volatility can force you out of the game. If you can watch the crowd succumb to the lottery ticket mentality, paying exorbitant prices for peace of mind, and remain focused on the mathematical probability of mean reversion, you have moved beyond the rank of a trader. You have become a professional insurer of market risk, and in the long run, the house always wins. Chapter 24, A Day in the Life, the Volatility Trader's Routine. The volatility trader does not wake up to check where the market is going. They wake up to see how the market is breathing. Long before the opening bell rings, the routine begins with a cold assessment of the term structure. By scanning the VIX futures curve, you are looking for the shape of fear. Is the market in its natural state of contango, where the future is more uncertain than the present, or has a shock forced the curve into backwardation? This initial triage determines your posture for the day. If the front month is spiking relative to the back months, the market is bracing for impact, and your first task is to ensure your portfolio isn't positioned to be the casualty of that collision. Once the macro landscape is mapped through the lens of VIX, the focus narrows to the specific instruments in your crosshairs. This is where the IV rank becomes your most vital tool. A high VIX tells you the sea is rough, but IV rank tells you if a specific stock's options are actually expensive relative to its own history. You aren't just looking for high volatility, you are looking for high relative volatility. As you filter through your watch list, you are hunting for the outliers, those tickers where the implied volatility has outpaced the actual movement of the underlying asset. This morning's scan transforms a chaotic sea of data into a prioritized list of high-probability sell or buy zones, ensuring that your capital is only deployed where the edge is mathematically significant. The final layer of the pre-market ritual is the Greek audit. This is a ruthless interrogation of your current exposures, delta, gamma, and theta. Volatility trading is a dynamic chess match, and your Greeks are the pieces on the board. You ask yourself, how much will an overnight gap affect my delta hedge? Has time decay, my silent partner theta, done its job, or is it being eaten away by an expanding gamma risk? By reconciling your global macro views with your specific Greek sensitivities, you bridge the gap between theory and execution. By the time the markets open, you aren't reacting to the news. You are executing a plan that was already written in the numbers. Chapter 25, The Future of Volatility, Adapting New Market Regimes. The landscape of the global markets is a shifting mosaic, reshaped constantly by algorithmic speed, geopolitical realignment, and the democratization of information. Yet, beneath the veneer of high-frequency trading and artificial intelligence, the fundamental mechanics of the market remain tethered to the oldest of human engines, the binary pulse of greed and fear. Volatility is not merely a statistical byproduct of price action. It is the mathematical representation of human uncertainty. As long as there is a future that cannot be predicted with absolute certainty, there will be a premium for protection and a profit for those willing to provide it. To trade volatility is to trade the very essence of the unknown, ensuring that this discipline will never truly become obsolete. However, the volatility edge is not a static destination, but a moving target. The market regimes of tomorrow will undoubtedly look different from the flash crashes and liquidity crises of the past. We are entering an era where social media sentiment can collapse a multi-billion-dollar institution in a weekend, and where central bank interventions have rewritten the traditional rules of the debt cycle. Adapting to these new regimes requires a shift in mindset from the rigid application of formulas to a philosophy of constant calibration. The successful trader must be a perennial student, treating every market anomaly not as an outlier to be ignored, but as a data point in an evolving thesis about how the world prices risk. As you conclude this journey and step into the arena of live markets, remember that your greatest asset is not a specific proprietary indicator, but your temperament. The evolution of your career will be marked by your ability to remain objective when the crowd is hysterical and disciplined when the winds are in your favor. Continue your education by obsessing over the why. Behind every spike in the VIX and every crushing drop in realized volatility, the tools will change and the math will grow more complex, but the opportunity remains the same: the chance to profit from the gaps between expectation and reality. This is not just a trading strategy, it is a lifelong practice of navigating the storm,